The Treasurer showed no surprise in the monthly headline inflation rate rising to 3%. That's the highest level in a year. And that's because he focused on the underlying rate, which is the Reserve Bank's preferred measure of inflation. That fell to 2.6%.
Headline inflation fell slightly in the month, but the annual rate increased slightly to 3.0%. That's because of the way that it's calculated, the base effects in that number, and also because of the timing of the ending of state energy rebates.
Well, the Treasurer might not have been surprised, but no matter how he spins it, the financial markets were, as Ingrid explained earlier. Now, Ingrid showed you the one-year bond yield. That popped immediately as the latest inflation number came down. The chance that rates would be left on hold at the Reserve Bank's next Tuesday meeting rose from 87 to 92%. Indeed, the market pricing now suggests a rate cut won't happen until February next year. An economist this afternoon, they're also considering their rate calls. NAB's economics team says there will be an extended period, perhaps until May next year, before there's a rate cut. Deutsche Bank's Phil O'Donoghue also changed his call. He now says the next rate cut won't happen until next February. One of the best credential rates callers in this country is independent economist Gareth Spence, who joins me now. Gareth, thanks so much for your time. I just want to know, were you at all surprised by what took place here, by what happened?
Well, to the extent that the data came in a little bit stronger than those that were out there forecasting, I think it does represent an upside surprise.
Yeah.
I think the Treasurer emphasising the underlying rate rather than the headline is a bit ironic, given 12 months ago he was very much focused on the headline because it had come down. I think the most important thing to think about when looking at these figures is the RBA cares about the quarterly rate of inflation, and that comes out in a month's time. This monthly data that comes out is pretty choppy and it's only partial. So the central bank will wait and see what that quarterly number is, I think, in a month's time before considering adjusting policy. And as you mentioned, the markets haven't got anything priced for next week, which I think makes sense. And for those in the market that are looking at that data today, trying to work out what it means for the quarterly number, they're crunching those numbers and thinking there's a bit of upside risk now versus what the RBA's forecast. I had to go on my spreadsheets to do and getting a similar result. And I think that then cast doubt on whether or not we're going to see another rate cut at the November board meeting, which heading in today was pretty much the widespread expectation.
I've got to say, Gareth, it's also important to get things right on this program as well. So Gareth Aird is our guest today, not Gareth Spencer, someone else. But anyway, so that's right. My mistake. But Gareth, just the issue here also, the market reaction showed that the market was surprised by this.
Yeah.
Why would be the market surprised by a sudden spurt in inflation? Caused largely, as the Treasurer says, by subsidies of energy prices coming off. That's known. That's a known thing.
That part of it was known, but it's the components that matter. And market services, which is what is measured in the second month of the quarter, so that got measured today, that was a little bit firmer than most had anticipated. And so what happens is analysts look at this data, try and then work out what it means for the likely print on the quarterly number, and that's the one that's coming a little bit further. Now, just to confuse things a little bit, the ABS also produces a trim mean measure today.
Yes.
And as the Treasurer pointed out, that did come down a little bit through the year terms. The problem is the way that monthly annual trim mean is calculated is different to the quarterly one, which is why analysts have got to go back, crunch the numbers and work out what they think it means for that quarterly number. And when people are doing that, they're getting a slightly firmer number, which then puts doubt on a November rate cut, particularly given the labour market data has been holding up with the unemployment rate basically sideways at 4.25%. And the GDP numbers were a little bit stronger on the consumption side than the RBA had previously forecast.
So all of this says that people should temper perhaps their expectation that the Reserve Bank is suddenly going to come out with 3 or 4 rate cuts from here. This is pretty much what it's saying, that inflation is not dead in our economy, that government is also going to be conscious of the potential that there is another spike, as we've seen in other parts of the world.
Yeah, inflation's never dead to the extent that it's always a positive number, or that's what the central banks are trying to do. They're trying to keep it in that sort of 2 to 3% range, and if it's coming down and policy is restrictive and it's there or thereabouts where they want it, they'll consider cutting rates. The thing at this juncture is that the Reserve Bank is still unsure how restrictive policy is or not. And in fact, on some models, policy is actually not restrictive. It's there or thereabouts at neutral. And so if they're looking at that inflation data saying, no, it's maybe a touch firmer than we thought it would be, labour market's still pretty tight, they will feel in no hurry, I think, to cut rates further. Now, that's a different story here in Australia compared to other central banks offshore, where you're seeing quite a weakening in labour markets and therefore central banks cutting rates. But I think off the back of some firmer data across the board, really, some of the monthly business surveys have picked up a little bit. GDP growth in the second quarter was decent. My sense is the central bank will take a more patient... Well, I think when they talk next week, they'll sound like a rate cut wasn't even on the table.
Yes.
And then when we get into November, I think where the labour market data lands as well as the inflation data will be pretty important. But for me at the moment, November looks like a coin toss. I can see why some houses would have changed their view today, and by the same token, those that have as their base case a cut in November probably feel at this point it makes sense to hold on to that.
So tell me, the sense of this is that rates are there to obviously have an impact on inflation and on the labour markets.
Yeah.
But broadly, give me a sense about Australia, because Australia's economy is really not growing that strongly right now. The OECD says it will pick up next year, but really those rate cuts would also aid the economic growth that Australia desperately needs right now.
Yeah, they do. And what rate cuts do is they help to stimulate private demand growth in the economy. And that's been the weak spot until just recently. I think what probably is feeding into the expectation at the moment, the RBA could be on the sidelines for a little bit longer than cutting again this year, is the fact that in the second quarter of this year, you did see quite a pickup in household consumption. It still remains to be seen whether that continues forward, but that's certainly the actual data that we've got at the moment. The other thing is, as I mentioned, the private business surveys are looking a little bit better as well. Yeah. Also, I think it's worth keeping in mind that the housing market is already responding to rate cuts, and you're going to see then a positive wealth effect filter through to the economy. So there's a few moving parts, but you can see why.
Gareth Aird, I've got to leave it there. Many thanks for your time. Appreciate your time on the program.